Okay, fair enough. Those are technical strategies. We have Gautam Duggad now joining us from Motilal Oswal Financial Services. Gautam, good afternoon. Thanks for joining us. It's been a one-way rally for the market, and a lot of people saying this is a liquidity-driven rally, which has absolutely no connect with the fundamentals. Would you agree with that view, or do you think this is a market which is already moving in, and the economic numbers will follow perhaps in 6 to 9 months?
Hi Anuj, good afternoon. I think any rally always requires liquidity. No denying about that. You always have to have a support of liquidity. But the important point is, even though our markets have rallied 40% from the bottom, the fact remains that we are towards the bottom end of the league table as far as global markets are concerned in terms of performance. And also bear in the mind that 2019 also we underperformed significantly. So while we have gained substantially and tried to play some catch up with the global market, we still are down much higher than some of the other global markets. Now clearly the other markets have seen a far bigger fiscal stimulus, but our market has seen just 1.2% kind of a fiscal stimulus. So in that context, what we've done over the last 1 month, 1.5 months is far outstanding in that sense. And I think right now market is looking beyond the near term and focusing more on recovery rather than just the lockdown related trade that we have seen. And as we do more opening up, we will see perhaps more clarity coming on corporate earnings side.
Okay, by the way, that's not a bad SIP number at all, and this has been I'm pretty steady, down 3% month on month. I'll take that any day in this kind of a market. But Gautam, financials, they have led the rally. They were beaten down the most, of course, as well. But the level of bounce in names like Bajaj Finance, HDFC Bank, Axis Bank, has it surprised you? And what's the way forward for some of these names now?
Yeah, I'll be lying if I say it didn't surprise me. It did surprise when it fell also. So clearly, when such sharp movements occur on either side, it eventually ends up surprising you. But what we have done is we still have a significant overweight in our model portfolio for financials, for the simple reason that we are heavily dependent on consumption in financial as far as this market is concerned. I don't belong to the camp which says financials will become irrelevant over the next 1 year or 2 years. I strongly believe that large cap financials will have substantial market share gain. Clear value migration will play out in its favor. Next 6 months are going to be very difficult, which we all know. We've heard the commentaries of all the large cap banks and mid cap banks as well, coupled with that NBFCs as well. So clearly the next 6 months are unpredictable. You might see volatility rising further and stocks giving up another 15-20% from where we are, because most of the banks have seen 40-50% movement in the last 30 days. So that can happen. But what I will do is, and that is what we've done in our model portfolio, we have used the correction as an opportunity to add weight to some of the large cap banks. And NBFC side, we are still cautious, barring HDFC and Bajaj Finance. We've had a neutral on Bajaj Finance for more than a year now, since 3,200. Clearly, things have changed substantially in the last year and a half on growth, asset quality, and liquidity. But for someone who's looking beyond the next 1 year and have a 3 or 5 year view, this kind of corrections in a large segment of the market, when they happen, they always present an opportunity to realign the portfolio. If in case you missed the big trend in the past, and if you continue to believe that this is a structural trend, which is financialization of savings, and within that the value migration towards better quality financials, then this correction is allowing you an opportunity to add on to those names. And that's what we have done in financials.
Okay, so you're keeping the faith on the big names, including some of the bigger NBFCs. Gautam got that. Good afternoon. I want to talk about one of your big, large cap preferred picks, and it's Reliance Industries, right? Now the question is here, I mean, all the deleveraging, almost all of it is already done. The rights issue is done and dusted as well. So what next? What is the trigger? Or if someone were to enter now, do they run the risk of coming in at a bit of a top?
Subhi, the point you have mentioned, Reliance has outperformed significantly in the last 6 months. it's almost back to its pre-COVID levels. And the deleveraging story, which was being talked about, and was a lot of people were skeptical about it. We've seen what happened in the last 20 days: 97,000 crores of capital raise in a lockdown. I don't think we have seen this kind of fundraising ever. So one part of the story is clearly being played out, which is the deleveraging. What still remains to be played out is the ARPU story. Both for Reliance and Bharti, and which is why we have a substantial overweight on Bharti as well in our model portfolio. I think while the near term there could be some time correction given the sharp up that we have seen on Reliance in the last 3 months, but if you look at the whole valuation of Reliance now, we do SOTP. 50% of the SOTP is now coming from a business which did not exist 5 years back, right? Rest 30% is coming from retail, and refining and petchem is now just 20% of the total SOTP. Now, this has been a business which has been in existence for more than 4 decades. So clearly, if there is one large business in the last 5 or 6 years which has been on the right side of the change that we have seen in the global as well as Indian technology domain, then it is Reliance. Now, obviously, taking a short-term view on such names after such a sharp rally becomes that much more difficult. But from a medium-term point of view, I think both Reliance and Bharti still offer a very significant and attractive opportunity to play the telecom story. Both of them have seen deleveraging. Both of them are going to be a big beneficiary of the ARPU cycle that we might see. And clearly, they're on the right side of the market share gain within the telecom subscriber domain. And then, of course, there are many unknowns when it comes to Jio. They have taken several initiatives on the technology side, Jio Mart, even on Reliance retail side. So just to give you an example, 3 or 4 years back, Jio used to have a negative value in the SOTP. Today, it is 50% of the total SOTP. So many things can change, just that structurally things are looking right for them at this moment. So we will remain invested over there as well as in Bharti. In fact, Bharti continues to have a 3% overweight in our model portfolio for almost 2 years now.
And that's a very interesting point you made, that just about 2 years back, Jio was negative value, was given negative value in SOTP, and now it's almost 50%. So that's why started to look at Reliance more as a telecom and digital stock more than an oil and gas traditional way of looking at things. And that's perhaps also one reason why it's driven this kind of valuations as well. But Gautam, what about a stock like Larsen Toubro? You have it in your portfolio. It's a stock which has really sort of frustrated a lot of people. At 1300 and 1200, it was seemed to be a stock with a lot of value, and it's only gone down. Of course, it's recovered in line with the entire market, but still down quite a bit. Your thoughts on this stock now?
It's very simple actually. In that space, there are not many investable plays. So if you have to make a token representation or allocation in that sector, then L&T becomes an obvious choice. If you see the portfolios of various mutual funds or other investors, you will find that L&T is a consensus play in that portfolio for infrastructure cycle. Because the problem is 10 years back, you used to have a lot of investable plays in those domains. Today, you just have one L&T, and then rest of the companies are struggling for various reasons. If you ask me, in our model portfolio, we have that simple top-down call that we need to have 1 or 2 stocks in that space. So we have L&T for infrastructure and Ultratech as well. But top-down, if you also see, we remain more biased towards BFSI, IT, consumer, auto, and we continue to have a slightly more cautious view since 2017 now on the cyclical and commodity end of the market, which is metals, oil and gas. Of course, metals have had a sharp rally, but I'm willing to miss that, given that it is going to be very difficult to time the entry and exit of some of the sectors. Specific to L&T, clearly there is a lot of value, but at the same time, it also has some sort of a disadvantage because the conglomerate structure and several holding companies that attract some discount here and there. And plus, in this kind of an environment where the capex cycle can get pushed back by a year or two, given that a lot of corporates are in a mode of conserving cash, and at the same time, government balance sheet also do not allow them to implement their fiscal plans, whether it is central or state government, I would want to remain cautious in that entire space. But within that, L&T remains the preferred play.
You mentioned consumer, Gautam, and I actually wanted to ask you that because when I look at your portfolio, I mean, on autos, you have Eicher Motors, if that represents discretionary. you've got AB Fashion and Retail, Crompton Consumer. So what is the larger play? I mean, are you expecting a very quick demand recovery as the unlock continues? I don't see stocks like Jubilant or PVR or Page, those kind of big consumer names, urban consumer names on the list. So what's the thought process here?
I wish the demand recovery was quicker. But Subi, the point is we just downgraded Jubilant after the sharp run-up that we had seen in the last 6 months. It was the best performing stock, and we thought valuations are very demanding, and demand recovery can take longer than what we are currently estimating or market is building, and that's the reason why we downgraded Jubilant. Page we had downgraded a year and a half back when we felt again the asking rate at 30,000 from an intrinsic growth point of view was becoming very tough to fulfill. So we downgraded Jubilant at that Page at that point of time. Now, from a consumption viewpoint, the view has always been very clear that as far as staples is concerned, we continue to side with companies where the market share gains are huge and where capital allocation as well as return ratios has been extremely strong. So the names that we like remains the same. There is no change in the pecking order. It is Lever, Britannia, and Pidilite on the staple side. On the discretionary side, as far as large cap is concerned, Titan has been a number one choice. I think a lot of these companies will benefit once the lockdown is behind, because smaller players in every sector, unfortunate as it may seem, but they will suffer far more, than the larger guys. A trend that we've been seeing since last 3 years post GST demonetization, that big will become bigger and better. And I think this trend will accelerate further post the lockdown. So we want to be biased towards guys we have which enjoy a far more dominant market share in every segment that they play in. So Pidilite is a virtual monopoly in adhesives. Lever has a strong dominant market share positioning in almost every category that it plays in. Same is the case with Britannia that we have seen 3 days back in the results. Titan remains the only pan-national branded jeweler, in India. I think they're reporting today. And then coming to mid-caps within the consumption domain, we want to be a little more opportunistic there based on valuations. So when Aditya Birla Retail corrected from 300 to 100, the EV to sales came down to just 1x. And that is when we introduced it in our top ideas list. Apart from AB Retail, what we like in that space is trade. And then selectively within the consumer durable space, our preference is with Voltas and Crompton Consumer.
All right, Gautam, good talking to you as always. Thanks a lot for joining us. That's Motilal Oswal's view on a lot of stocks. We need to take a short break as